So welcome everyone. Thanks for joining me today. So I'm going to cover a hot topic before 30 June, taxes. For those who find taxes a bit daunting, probably the best, I'll try and make it simplified for you today. And why is it so important to make sure that you do tax planning for your business? Everyone today that has been invited has a business or run whether it be small or big, and it still makes a difference. But if you do have the right, I guess, knowledge and structure for your business, and I'll go through an example later on, and also we'll talk through briefly of how you can get help if you do have a business and you want to make sure that you're not paying more than your fair share of taxes. Okay, so today's topic, I'm going to cover 12 tips for you as a business owner to legally save $25,000 in taxes before 30 June. For those who don't know me well, I'm a chartered accountant and founder of Success Accounting Group, now over 15 years. So we work with business owners who value family as the most important thing in life. If your business is a family business and it's turning over $200,000 to $3 million, our team can usually bring at least $10,000 to $25,000 extra cash flow per annum. Now, I know there are a few startups that have joined in this webinar. It's not, look, my view is that it's always the best to have the right structure from the beginning, because if you set up, everyone is a startup initially, and if you set up your business in the right structure, that means that when you do reach the time when your business requires to pay tax, then it's already set up. From my experience anyway, if you set up and change later on, then it could be costly for you. Okay, so we've got a campaign to say to help our tax and business clients to give back $5 million of cash flow. And in order to do that, I mean, at the moment, cash flow is the number one thing on business, small business mind, because with the coronavirus, with the restriction, it is very hard for your business to make the full potential. And taxes, as you know, is one of the major expenses for a business owner, only second to wages and rent. So we're trying to combine with tax planning as well as the economic stimulus that the government has so generously offered to help small business to make sure that they survive during this COVID-19 and thrive after that. So we want to make sure that we give it back, and using our tax planning meetings to go through with your business step by step to make sure that you've got all the economic stimulus that you're entitled to. Also the tax strategies that you implement before 30 June, having the right structure, and we'll go from, to make sure that, to ensure your business will be in a position to thrive post-COVID, which is really at the moment in transition with the restrictions being lifted up. So this is my meaning of what wealth means. So wealth to me, the other day I listened to Robert Kiyosaki. He mentioned this as well. He agrees that wealth is the ability to fully experience life. So it means that you have more time in your life. The more time you have to make choices of your life, that is wealth. That's Henry David Thoreau's. Now, we believe that with the extra cash flow that we give back to our clients, that's a way of helping our clients to give back their freedom, their time of freedom. So it is a very important, meeting. It's a very important time to help our business owners to at least have that a little bit extra freedom in their time for their family, as well as building wealth through minimizing taxes. So at the moment, so far we have already worked with several of our clients, and at the moment we have achieved magnificent results already, and I will go through some of the later. Now, before we start, I want everyone to comment below. So what kind of structure you're currently running your business in. So there are three main structures: sole trader, company, and trust. And I want you to just quickly put a comment what industry you're in and what structure you're doing, actually, like whether you're sole trader, company, or trust, so that we can, and then I'll go through the differences in these three different types of structures. So I'll have a look, I'll pause a bit and wait for everyone to put their comments in, because this is very important. I mean, part of this webinar is to learn from me, but also to understand, learn from others as well, to see. So if I want to know, one, what business structure, what industry you're in, and what structure you're currently in. Okay. All right. The answers are coming through at the moment, and this is more a integration, you know, a collaboration here. So we want to know everyone's answer. Okay. So let's have a quick look. Yep. Thank you. Yes. Good. Everyone else is still being a bit shy. So hopefully towards the end, you'll be understand what kind of structure should you be in, okay? Or at least should you be in from 1 July. So you can see here, sole trader, company, and trust. So they're not equally the same. So how much tax does each pay? Sole trader is the most expensive structure, because what's the best structure for you will determine on your goals for the business. Now, if you look at how much tax does each entity pay, I'm assuming that, let's say, each entity earns the sufficient income or profit to pay that tax. So let's say 200,000. So sole trader can pay up to half of that to the government. Now that's a really high tax rate, and therefore, let me just, I just realized something. Okay, so that's better. So therefore, it's not worth, you know, running a business and paying half of that in taxes. Can everyone just comment that they can still see my screen? If not, I'll share again. I'll just share it again. Okay. All right. Design. Okay. Okay, so therefore, as you can see, a company structure at the moment is taxed at 27.5%. So I saw, I think, one or two people in a company structure. So clearly, if you make 200,000, therefore 46, you know, that's almost half of what you would pay, you know, if you were running your business in your own name. Now, when the trust is there could be several types of trusts here: the family trust, the discretionary trust, the unit trust. So depending on when our accountants assess your business, depending on what type of goals you have, we will determine what kind of structure. So looking at this, I can see that 47, 27, and none doesn't mean that you don't pay at all, but it's actually none in the trust, but it flows through, the income flows to your beneficiaries that you choose, and it's taxed at the marginal tax rate of the beneficiary. So therefore, as you can see, if you're currently in a sole trader, you're paying way too much tax. Company, I still feel you're paying too much tax, because that's still about $56,000 if you're earning 200,000. And if you're in a family trust, then if you have different beneficiaries with a low income that you can distribute to, you'll be way off better than a sole trading company. And I'm going to run through a detailed example of how this can happen in a structure, in a trust later on. Now, sole trader, the second factor is, can I distribute? So sole trader, which means is in your name, you cannot distribute. Okay, that means that if you earn 200,000, you need to give that 200,000 to yourself. So that means very limited flexibility in terms of how you can spread the profits. Company, there is if some ability to distribute to the shareholders, which is, let's say you and your wife is a shareholder of the company, then you can, at 50%, then you can distribute to your shareholder. By the way, I won't stop for questions. I may stop for questions at the end, but so please put your questions as our webinar go along, and then we'll come back to questions later if you have any. And finally, trust. Yes, that's the most flexibility. So you can distribute your sales profit amongst your beneficiaries, your family beneficiaries, according to the family tree. So I will go through in detail what are the 10 entities that you can distribute through the trust in the next case. Does it protect your assets? Now, this is very important. If you're running a business, you've just increased your risk as a business owner. So if you're an employee, and you work for an employer, and if you made a mistake as an employee, the business risk still sits with the employer, your boss. So therefore, if you're now the boss, then guess what? Congratulations, but you are now just, all the risk is onto you now. So asset protection is a strategy to make sure that now you started this business, that you're not also opening yourself to risk from other people suing you and the potential of losing your home. Okay, so definitely sole trader is a no-no, because if you run the business under your name, that means that the people will be, any assets under your name can be liable to be sued or taken. And company, there is asset protection, and it's with the limited liability, and trust with a corporate trustee, there is asset protection. Okay, so quickly guys, now that you have an overview of the different structures, what structure would you like to be from 1 July? Now that, so you did answer what structure you are at the moment, what structure would you like to be? Given that you've learned now the basic concept of how much you would pay in a sole trader, company trust, and obviously the differences. I just want everyone take quickly 10 seconds to put it in, and then we will go from, we'll compare our answers. Let's see. Okay. Trust, still company. Yep, good. Trust, yep, trust. Okay, yep. Glad to hear that. Still company, yes. Okay, great. So no one is sole trader. So therefore that's good. That means at least my message has worked for you. So let's have a look at the. I'll just close this. Move to. Okay. So now we've answered this question: what is the current structure you operate, and what structure you would like to be? So if you're thinking at least a company or trust to have the asset protection, and the trust is more flexible. Obviously, if you are operating certain businesses, you can have a company and mix with a trust. But if you want more tailored advice, and please get in touch with my team. Now, the thing that I like to say also is that just because you're currently a company, for example, or currently a sole trader, does not mean that it's still valid. Like, does not mean that it's still the best structure for you, because as your business expands, the best structure could be different for you. Does that make sense? So your business needs to grow with the growth of, your structure needs to grow or modify with the growth of your business. So it's always good to have that check-in meeting with your accountant once a year for tax planning to make sure it is still good. All right, I'm going to go through this. And if those people who are in a trust, you're in for a treat, because you need to make sure a trust is like a Ferrari. If you don't know how to drive it well, then you're not making the use of your Ferrari, okay? So 10 peoples or entities your family trust can distribute profits to. Okay, so I have put the top 10. There's others, but let's look at spouse. Spouse is number 1. Now, for those who run PSI businesses, because I know there's a couple of our clients are joining today, that there is a different set of rules for that. So you can't always distribute your PSI income to other beneficiaries. But for the general businesses who run businesses that serve to multiple clients, then you can effectively distribute your profits to these entities. So if it's, take a husband who makes lots of profit, and and the wife is staying home. So the first entity that you can distribute is to your spouse. Okay. And likewise, if you're a modern day and successful woman and your husband is at home, you can distribute to your husband, and if he's not earning as high income, because his tax rate will be less than obviously yours. Okay. So why do we do that? Because obviously the tax rates are tiered in Australia. The next one is kids. Now, if you have kids, young kids under 18 years old, you can distribute to them as a minor up to $416 a year. So if you have 4 kids, 4 times $416. Now, for those who have uni kids, like over 18 years old, they're the best because they're going to be in uni for at least 3 to 5 years. So you can make sure you maximize that use because, and I know Gaiety, I think you mentioned your case, you had some older children. So if you were to, let's say, have profits, you don't have to only distribute to yourself, but they can be a adult beneficiary, which means that you can distribute to them $20,000 a year and pay no tax. So that's amazing. I mean, that's something that it's legally, you can do that. The third one is siblings. Now, if you have siblings that, maybe not working, looking after children, or just not, or out of a job, then these adult siblings, then you can also distribute to them because, again, 18,000 up to is 0 tax, and then the tax rate is still low. So if you're earning like 200,000, you can spread that profit legally to them. Okay. These are the ones that are probably less known to most people. So you can also distribute to your adult parents. Parents who are maybe semi-retired that don't, maybe just living off lower income or investment income, or just working part-time. Because remember, if their income is like less than yours, let's say they only work part-time at the canteen at the school, $10,000, then potentially they can take on more of your distribution profits from the trust. Okay, same with in-laws. So I'm assuming that, they're in their 50s or 60s, so they can certainly look at taking on some of your income, so to reducing your profits. Now, if you're lucky enough to still have grandparents that are still alive and are not, not ineligible to receive trust distribution, then also consider them as a beneficiary.
Thank you. Bye.
Please mute if you're on speaker, please. Yeah. Okay. So number 7, these ones are actually not being used by a lot of our clients. So we will go in. So if you do have a discretion trust, you can, and if you have a second business, let's say you have a profit business, and then you have a second business that you're just starting up, then therefore what you can do is that loss-making second business, you can also transfer the distribution from the trust, the profit-making business, to the loss-making second business. Now, a lot of people who are currently working as I see a lot of people working as an employee and then starting to set up their side hustle. Now, if you had done that in your own name, then you won't be able to accumulate that losses, because it's called, sorry, you won't be able to offset that loss in your salary. It'll be considered as deferred loss. But if you, let's say you open a side hustle and obviously this first year is going to be most likely a loss. And then as you build it up, then it become profit, you can actually offset the future profits to the losses that you accumulate from the early years. So it's not all, it's actually quite advantageous to have the right structure at the start. Is there any questions? Please put in the boxes as we go, yeah, because we will come back to them. Number 8 is distribute to a bucket company. Okay, so as you can see, the bucket company is capped at 30% tax. I'm talking about clients now who are making, let's say, 300, 400, 500,000, where their tax is clearly, if it was in a sole trade, it's half, so it's 150,000 for 300,000 profit, and they're clearly paying above their, they may have run out of beneficiaries, the individual beneficiaries, and now they're looking at how to cap their tax at the you know, at the 30% rate and no more. So if you're paying more than 30% tax, that means there's something not right about your structure at the moment, because a bucket company allows you to limit that. So if you're let's say earning over 300,000 or 250, that's probably the time where I would be considering a bucket company for you. If you like to help out charities and churches, well, this is an opportunity to do so. So if you're running again in a trust and you want to distribute or donate to charity, you can do that through your trust, okay? But obviously there's some documentation that you need to do. And finally, number 10 is super fund. So you can distribute to your super fund. When I say distribute, I mean that through your as a business owner, okay? So that's number 10. So those are the 10, actually, those are the 10. It's not just, a lot of people get that they can distribute to their spouse, their children, but not everyone knows and take advantage of the 10 entities, yeah? So just quickly, in the chat, if you do number 2, if you do thinking of having a trust, who out of the entities, which one would you be looking at distributing? Quickly, and while we move to the second one. And any questions, please, I'll have a look, go to questions now while we wait for the comments and go to our case study. All right, so let's have a quick look at our comments. Distribute to adult children. Yes, Robin, that is absolutely correct. I know you, adult children, loss-making business. Yes, Koi. we all are inspired to start a business. And if you have a loss-making business, then that's a good way to offset any profit-making business, yeah? So adult children is the best, because, you know, if they're, as I said, if you've got a couple and if you say you have 2, then that's 40,000 of tax-free money. Okay. Okay, so I'm going to move on to our rich client here, who is, as you know, earns a lot of money. Now, let's follow this case study, and I've just picked without tax planning. Okay, so let's say this client, as you know, James Packer, has $380,000 in profit this year. He would generally, now these numbers are all estimate, okay? So he would generally pay tax in the company. So he has a company of 108,000, which is about the 27%. 8.5% in tax. That's quite a lot. I mean, you think about it, if you earn that much, 380, and you had to pay even a third, that's hard work, isn't it? It's like saying, and I say to my clients to I guess make them aware, it's like working 5 days, but you only get paid from Wednesday. If you think that is fair, then and if that's how you want to run your life and your business, then so be it. But if you're our clients, I would make you aware that that's what you're doing if you're running your business as a sole trader. So Monday, Tuesday, you work, no pay. Wednesday, you get paid, because it's almost 30% tax. Now, let's go through a trust then. So lucky James Packer came and did a tax planning strategy with myself. And we know that he can distribute 18,000 to his spouse. He has 3 kids, which are minors, so that's under 18. So we can distribute $416 to them. So that's $1,248. He has parents and in-laws, so there's 4 of them. So 18,000 each, assuming that they don't work and they don't have any investment income. So that's 72,000. He's very generous. So he gives 15,000 to charity. He puts in now 29,000. Obviously, it's 25 this year, but there can be unused concession super as well brought forward. But let's just assume it's 29,000 to the super fund. He has, because of this coronavirus, he started his side hustle, but not making a profit yet. And he's distributed 25,000 to the loss-making business. And finally, he has 2 grandparents that still alive and not earning income. So he's given them 18,000 each. So you can see what I've broken down here, that after tax planning, 380,000 that he made in the company, less than 196,248 distribution, equals taxable income of 183,752. So the estimated tax saved is 55,930 in tax at 30 June. This is not short of, this is what the rich do. This is what the difference between getting good advice, proactive advice before every year, 30 June, and not getting it, okay? And this is based on an income of 380,000. Now, for those people who earn more, the saving will be more. So as you can see, it's something that is accepted by the ATO. So if you're not structured correctly, you're basically donating, in addition to what your taxes you pay, well, in addition to what, the taxes like GST and that you pay, you're also donating an extra $55,930 if you earn this much. Okay, so I don't want you to work so hard like that. That's if you want to donate, then you can at least choose your charity. But rather than just being forced to by donating to ATO and then not being aware. So please, it's very important to make sure that you understand this. If you have anyone have any questions on this particular case? Yeah. Okay. All understand? Good. Okay, let me see if I can do the next one. Okay, so all I wanted to say is this was, here are some of the people that have gone through as clients with us and done tax planning every year with us. Now, this year's tax planning is more exciting and more, I guess the extra cash flow is bigger because of all the economic economic government stimulus that the government has generously offered to help small business who have been impacted by COVID. So for example, a client that we did tax planning 2 weeks ago, Danny Bathroom, we found an extra 185,000 extra cash boost and tax savings for him. So that includes tax savings for his business. He was about $1 million business. And also the cash boost, JobKeeper, grants that he was able to receive. That's 185,000 extra cash flow to our client. Now, we worked out also what extra time would that give to our client? Because a lot of people say, oh, money to me is not everything, but I would say, okay, if we can give you 185,000 extra money in your pocket or to you, then that equates to almost 6 months, to this client anyway, 6 months of free time. So he would have to work 6 months to earn that same net income. So if you're thinking about it, you think, okay, money is, because a lot of people don't do tax planning because they probably put that as a last, not as important. But if I give you 6 months of your life back to do anything and still earn, how would that make you feel? Please share it in the comments, because I think this is the kind of stuff that we can help our clients do. And I'm sure we can extend the offer to you too, if you haven't got this experience yet. This lady, Sarah Bishop, she's she doesn't have any employees, just herself. But this is the early years where she was trying to save for a holiday. And the tax planning meeting allowed us to find an extra $6,000, which obviously it wasn't this year, but the previous years, where she was able to fund her holiday. So really, I think for us, it's not just about giving you money back, but actually giving you the choice of what you want to do with that money. So for Sarah, it was just $6,000 so she can go on her annual holiday. For Danny, the other gentleman, he was a builder. It was to fund his next building project. Okay, so that was important because he had to, he wanted to look at the next project. So what put in the comment quickly now, what is, if you had an extra 10,000, what would you use that for? Okay, I would like everyone to put in, what would you use for 10,000, what would you use the tax planning saving money for? Give you a minute to do that. And then what I'll do is I'll open the floor for how we can help you, okay? And any questions. Okay, so just quickly going through questions. Yes, Gaid, you asked about your residents for your, for beneficiaries, they need to be Australian tax residents, correct? Not, so if you have parents overseas and they're not resident, then you can't invest, you can't distribute to them. Gaye, you saying invest back in business or holiday? Yes, fantastic. And there'll be opportunities for holidays, hopefully when they lift, and it'll be good deals for everyone. Family holiday. Everyone's dying to go on holiday. And new plants in the garden beds. You'll be able to buy a lot of garden beds, Robin, with that money. Holiday. Dan? I think everyone has a lot more money now that no one's able to go on holiday for the last 6 months. Okay. Well, let us, our team help you. So what can you do? What can you do to make sure you're not paying, too more tax than you need to? Deposit for another property. Thanks, Graham. Absolutely. For those investors, property, that's a good way of reinvesting the tax save to building wealth. Okay. So everyone has a purpose for doing this excess tax planning, because everyone has a goal. Leave it to your suggestion. Yeah, everyone has a goal or a job for their money, right? So no one can say that they don't need that tax saving, okay? Because whether it be holiday, deposit for investment, or reinvest in your business, or just paying, tuition for kids, for those who have small kids like myself, a tuition for your kids, or just going extra, spending a day off from your business, that's something you can afford. So what's the next step? How can you implement this with us? So what I've done is that not everyone has done their tax planning as yet. So we offer a business health check for your business. Tax planning is the first one, because as I can show you, if you're currently a sole trader, or if you're in a trust but you don't know how to make use of that trust effectively, then book in a tax planning with us. When we save you the tax, the extra cash flow, then we will suggest that you reinvest some of that into wealth planning for your family. Yes, take aside 6 to 10,000 or whatever for your holiday, but make sure you reinvest that into planning for your long-term wealth. Because as you know, you cannot afford not to plan for wealth in case there is a second wave of coronavirus, or the extended restrictions. So plan for it now. Okay. We in the business health check, we also do a review of your current business structure to make sure you've still got the best one. And finally, this is something that I help with my existing clients, is to review your KPIs to boost profit. So for example, if you're in business, your sales are unlimited, which means that unlike an employee, you can actually, if you work harder and if you operate your business better, you can also boost that profit. And boost the sales as well. So a business health check is to make sure that you're running a business that is healthy, efficient, and paying minimal tax. Okay, so this is offered to everyone on the webinar today, and I recommend you take it up, because it will make sure that give you peace of mind, and it will make sure that you're setting up yourself good for and strong for the new financial year that is coming up. So for those who are on this webinar, then we are offering you to you know, a one-time investment of to get the extra cash flow of $10,000 up to, and the only investment is $550. And normally our tax planning meetings, we could charge anywhere between $500 to $2,000, depending on the complexity of the business or how much strategies, you know, involved. But for everyone on the webinar chat, we will offer this one-time bonus, because we really want to make sure that it's affordable and that you take on this offer today. So, I mean, straight after the webinar. So if you would like to for one of my accountants to contact you, please leave your name or at least comment below after this. Just say tax plan, and one of my accountants will get in contact with you. Okay, after the webinar. Now, before I'm going to now open the book, open for questions. Any questions that has been covered. Now, remember, I haven't covered everything in tax strategy, because I will reserve that for the one-on-one tax planning. There has been a lot of other strategies that you can do apart from today's presentation that, you know, before 30 June that could save as well. But I will reserve that for those who take up the offer, yeah, because then it will be tailored to your business. Okay. Koi, is there anything else you'd like to add? Koi is our compliance manager who's been watching the whole time. And if anyone would like to, I will just stop share now, and I will go in and see if there's anything else you'd like to add. So
the only thing I just want to add, hi everyone, is that the common tax rates at the moment it's 27.5. But next year it'll be 26, and then we'll go down to 25 the year after. Yes,
yes. So for those who have a company amongst your structure, Cor, you'd like to repeat that, because that's a good.
Yeah, so the common tax rate at the moment is 27.5 up until June this year. 2021 we'll go down to 26%, and the year after that, 21, 22 onwards, it'll be 25%.
Okay, great. Yeah, so there's some reduction in that company tax rate. That's a good thing for companies, people with companies. And even if you run a trust, you can also have a shareholder that's a company that could benefit from that too. Okay.
That's for dumping purpose.
Yes, yes. So I'm just going through any other questions that anyone have about today's webinar, please. Otherwise, you can ask, speak directly to your accountant or to myself, and then and book in your one-on-one tax planning, and then we can go from there. Because I think tax planning, even though we try to, this is general advice, so we don't know your situation, therefore it's hard to, you know, to cover everything, and certainly it's not designed to be a tailored personal advice. But at the tax planning meeting with myself or Koi, it's very robust. So we look at everything from what you're able to take advantage of the tax strategies, and also especially what you haven't claimed for the economic, you know, the government's stimulus. And I hear that they already announced about the new grants for building as well. So Koi, I think Koi's across this more than me. So Koi, you want to have a quick, give them, so it's not law yet, I know, but it's just announced. So quickly, Koi, you want to say something about that for those who are interested?
Thanks, Lan. Yeah, it's a 25,000 grant that that gives anyone who's thinking of or planning to do some major renovations, but more likely is buying or building new properties. We're talking about principal residence, so house that you live in, not investment. Up to 750,000 for new properties, or for existing up to 1.5 million. Then you can apply for a $25,000 grant from the government, and this is to stimulate the construction industry. And what they're saying is that, so you got the next 6 months. So the contract should be signed after the 4th of June, which was yesterday, and the construction should begin within 3 months of signing the contract. So say if you sign on the last day, 31st of December, then your construction need to be need to start by 31st of March next year.